He's UBS senior strategist, Nick Nelson, and he's with me now in the studio. Nick, let's kick things off with, what is going on right now, because every day it's another fall, it would seem.
Sure. Yeah, I mean, I think we've had a string of bad pieces of news flow from very disparate parts of the globe. So we've had, obviously, the news from China on steady tightening of policy. We've had the politics in the US with Obama's bank reforms, and we've had concerns over sovereign debt in Greece. So there's three pretty disparate effects at a time when the market was quite extended and people's risk appetite and bullishness was quite high.
But if we had this just 3 months ago, it would have been a situation where the good news would have been absorbed and the bad news ignored, and we're right now seeing the reverse of that.
Yeah, and I think that's partly because the market has run so fast. So we're up over 60% from where we were on March the 9th, so you could argue it was due some sort of correction. Also, we're only just starting to see the earnings coming through for Q4, and I think that will be the support. I think that's what will get us out of this mini correction.
And what are you making of these earnings that we have been seeing, not just from the US but from Europe as well?
Yeah, I mean, it's early days in Europe, but in the US so far, we think revenues are up for the first time in 5 quarters year on year. So they're up perhaps about 1% year on year. So
it's just the demand side is picking up.
Exactly, because I think in the summer last year we saw companies cut costs very aggressively, and that was fine. But we needed to see top line recover, and I think we're genuinely starting to see signs of that, both in the US and indeed in Europe.
Okay, so where do we go? How long does this last for? I mean, we've got 8 minutes. 9 minutes left of before the trading day begins.
Well, look, I think we're down again today, perhaps because we were down in the US overnight. We're perhaps down 5 or 6% from where we were at the peak. Perhaps it's a 10% correction, so I would argue we're roughly halfway through it.
Right, so perhaps to the end of February or something along those lines is possible here as well. Let's talk about China and the weight that it's been putting on the markets here as well. You mentioned that. There's been talk, Goldman Sachs' chief economist Jim O'Neill saying that they may well be revaluing the yuan by something like 5%. Is that something, do you think, that really could happen here?
I think our view is that that may happen, but it will happen perhaps gradually and probably in the second half of the year. Clearly, they are starting to tighten policy, but they told us about this in Q3 last year that they'd be tightening. And, bank loan growth was running at 35% year on year. It had to slow at some point. So I think we're seeing signs of that now.
So when you look at what's happening in terms of your stock selection, do you stay away from the emerging market side of things at the moment, just wait for this to play out, or what do you do?
I think there has been a change in the tone in the market, and we have been moving to some of the selective defensives. We did this in December, so pharma, for example, we upgraded. So I think the rally will broaden out, and it won't just be the leadership we saw from March to the end of last year. So I think a broader rally when we come out of this.
Right, so defensives for how long? I mean, that's the other thing.
Yeah, no, look, I think that's the theme for, the next month or so, but also gradually I think we'll have a period where the market can go up, and it won't just be banks and mining stocks leading the market. We'll see some large cap stocks that might come back into vogue as well. So I think a different feel within the market than we had last year.
A tale of two countries as well. Germany, we saw the EFO number yesterday, the highest level since 2008. And 18 months of recession coming to an end in the UK, but
yes,
just
it
barely.
wasn't that convincing, was it? Look, I think with these numbers, the Q3 number has already been revised up. We think the Q4 number will be revised up as well, probably. The survey data, the PMIs, are certainly suggesting stronger growth than the anemic 0.1 we saw in the report the other day in the UK. So some recovery, but a modest one.
No, but I mean, how much do you weight your portfolio, let's say? And I want to talk about Germany as well here.
Yeah. Oh, right. No, look, I think the UK certainly has a slower recovery, perhaps, to say Germany, much more export exposed, benefiting more from the pickup in global growth, a more cyclical market as well. So I can see advantages being in sort of the German global growth exposed.
But also with the FTSE 100, you buy the globe as well, don't you? Here?
Well, certainly the FTSE 100, the UK large caps, I think that's very true. And you look at the top 10 stocks, have very little to do with the UK. This isn't UK PLC. But the mid caps, the 250 and the smaller caps, those are ones I'd be more cautious on.
Okay, how much do you think earnings are going to be up this year? And also, well, what do you avoid?
I think earnings will be up 25%. That's what we're looking for pan-Europe, pretty much the same
for
in the
2010.
UK. Yeah, 2010 on 2011. A lot of that is base effects from banks, miners. The underlying number is closer to 10%, so I don't think it's that aggressive, but 25 at a headline level. And what do you avoid? I think you avoid some of these smaller mid-cap stocks that did very, very well last year, the very leveraged stocks, the low-quality stocks, and the super cyclicals that have run already.
Banks?
Banks are interesting. I think there's probably too much pessimism on banks now. Price to books relative to the market are about 0.5, i.e. they're trading on half the market value for that. So there's probably some upside, but a whole load of concern over news flow currently.
Nick, great seeing you as ever. Nick Nelson there from UBS, senior strategist.